Hi everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday 21st of February. We were expecting downward movement for Friday because I am expecting now that intermediate wave 4 has arrived. As this bull market finally comes to an end, I am expecting two more big multi-week pullbacks or consolidations, and the first of those final two I expect has likely arrived on Thursday. I'm expecting support about 3259, but if that expectation is wrong, it could be too low. It could be a quick sharp pullback, or it could be a time-consuming sideways choppy consolidation. And the light box is still not working, but we are hoping to get some fix for that this weekend. At the weekly chart level, this is my wave count for the S&P. It's been pretty much the same for months now. I am expecting that a cycle degree fifth wave, or it could just be primary degree. I have another weekly chart, we'll get to that at the end. A fifth wave is unfolding as an impulse. When this fifth wave, which begins here and is labelled cycle wave 5, is complete, then within it we should see the corrections of primary 2, intermediate 2, minor 2, and the counterpart, minor 4, intermediate 4, and primary 4, all should show up clearly at the weekly chart level so that we can count an impulsive number for the wave count of cycle wave 5. It's really common for this particular market to exhibit extended third waves. It looks like a stretched out accordion, and so we can see this correction and this one and this one. Now we can see minor 4. I am expecting now to see further downward or sideways movement for intermediate 4, which may not move into intermediate wave 1 price territory below the invalidation point. And when it's done, more upward movement as the bull market resumes for intermediate 5. When I know where intermediate wave 4 has ended and intermediate 5 has begun, I will then apply Fibonacci ratios between intermediate 5 and either one of intermediate 1 or 3 to calculate a new target for primary wave 3 to end. And I'll see if I can calculate a target at primary degree as well to give a small target zone. If we can find a confluence of target calculations clustering around a certain number, then it would have a higher probability. That's the general approach to target calculation for Elliott Wave counts. This channel is really important. I have given exact price points and dates to members in the text and chart analysis on how to draw this channel. This channel is drawn from the end of cycle 1, which is well off to the left of the chart in September 2014, to cycle 3. This is the first trend line, and then a parallel copy is placed on the low of cycle 2. And when you do that, it perfectly shows where cycle 4 found support and bounced strongly up from there. And that indicates the channel is most likely drawn correctly. If that's correct, then there is an important implication. It means that cycle wave 3 is shorter than cycle wave 1. And so, because a core Elliott wave rule states that cycle 3 may not be the shortest of 1, 3, and 5, that means that 5 is limited to no longer than equality in length with 3. And so for this wave count, at weekly and monthly chart time frames, the correction of intermediate 4 and then the bullish move for intermediate 5 and the correction of primary 4 and the final bullish move for primary 5 all have to complete at or prior to this limit being reached, and that limit is now quite close by. And so this wave count essentially expects a slow topping process maybe beginning to be forming. Here's the first little pullback here, lasting just over a week, and now I'm expecting intermediate 4 to last at least a couple of weeks and possibly longer. It could be a more time-consuming correction in relation to its counterpart intermediate 2. If intermediate 4 unfolds as a more time-consuming structure like a triangle or combination. It could, however, be any Elliott wave structure. Let's take a look now at the daily chart. We're going to zoom in on this extending third wave from this high here, which is this point here. Here's a quick zigzag for intermediate 2. A long extended impulse for intermediate 3 could now be over, and I'm now expecting a more time-consuming correction for intermediate 4 may have just begun at the end of this week. I've put some labels on here, but this is probably going to change as it unfolds. There are more than 23 possible corrective structures that intermediate 4 may unfold as if we include all the different kinds of triangles, flat corrections, combinations and all the varieties within combinations. It could also be a zigzag. It's absolutely impossible for me to tell you at this stage which of those many possible structures intermediate 4 may unfold as, and so the focus of this analysis over the next week or so, or few weeks, will be, or should be, on identifying when intermediate 4 is likely to be over, not on trying to identify each little swing within it. And that's analogous to expecting prices entering a consolidation and understanding that when price swings from resistance to support when it's consolidating, it won't do so always in straight lines. It can be really choppy and overlapping. Elliott Wave will give you a bit more structure, a bit more guidance as to how the swings may unfold, but you have to have a great degree of flexibility and wait for a breakout. Intermediate 4 may not move into intermediate 1 price territory below the invalidation point. Draw this Elliott channel around this middle of primary 3 from 1 to 3 with a copy on 2. There's some overshoots here, that's okay. I will expect intermediate 4 initially, if it gets down that low, or if it's time consuming enough, to find support at the lower edge of this Elliott channel. Fourth waves are often contained within these channels, but not always. Sometimes fourth waves can breach those channels, and when they do, we then redraw the channel using Elliott's second technique. But for now, initially, let's expect support about this rising trend line. Here's the upper edge of that multi-year, or over a decade now, trend channel that I've copied over from the weekly chart. It's been overshot and now price is returning below this very significant trend line. This is not perfectly where price is finding resistance, but it is still a very significant trend line because it's so long held, and so this has the right look, seeing intermediate 3 over here and intermediate 4 beginning an overshoot for the end of intermediate 3 looks absolutely normal. That should be a fairly strong piece of movement. There was also an overshoot for in primary 3 within cycle 3, and that gives the trend channel a really normal look. At the hourly chart level, we're now zooming in on the structure of intermediate 4. It may have begun here. It would most likely unfold as one of either a flat, combination or triangle, and those usually begin with a zigzag to the downside. I'm going to label that so far minor wave A. Here what looks like a possibly completed 5-wave structure to the downside. I'm labeling this minute A. I'm expecting a little bit more of a bounce, possibly for minute B, may be unfolding as an expanded flat correction, A, B, C. It could have been over here, but I'm choosing to label it as continuing because if I label minute B over here, then I'd have to put minor A over here unless minute C is extending lower, and this just, I would expect minute C possibly to not have this movement within it. Although if price does just continue lower and we don't get a little bounce first up to 3356.04, if it just continues lower next week, then I will label minute B over here and minute C extending and continuing lower. When minor wave A, or could also be labelled minor wave W, if this is a combination or double zigzag for intermediate 4, when A is complete as a 5-3-5 zigzag, then I'll expect price to move into a complicated B wave, or it could also be a quick sharp bounce, which may then make a new high beyond the start of A, as in an expanded flat running triangle, or if it's wave X, a combination. Once minor wave A or W could be complete and price moves into a B wave, it would then be in a B wave within a fourth wave. The most difficult portion of any consolidation or correction to analyse is the middle of it, the B wave. If intermediate 4 is deep enough or time consuming enough, look out for support at the lower edge of that channel, copied over from the daily chart. Intermediate 4 may find its final support about the 0.236 Fibonacci ratio of intermediate 3 at 23258.67, because that's the Fibonacci ratio that is within the price territory of the fourth wave of one lesser degree, minor wave 4. Alternatively, at the daily chart level, if we just move the degree of labelling within this last rise down 1 degree, it's possible to see minor wave 5 of intermediate 3 continuing and extending higher. If we see a new all-time high early next week, then this would then be the main wave count, and this would be the target for minor wave 5 to reach 1.618, the length of minor wave 1 at 3538. This target would mean that the limit on the weekly and daily chart for the main count would be breached, and then we would move to one of the much more bullish monthly wave counts, and you can see those outlined in the monthly analysis, which is linked back to at the beginning of every text and chart analysis every day and every week for Lara's Weekly. For this idea, minute wave 2 may not move beyond the start of 1 below this invalidation point, which isn't particularly useful for the main wave count because the main wave count expects choppy, overlapping sideways movement, most likely would possibly remain above this point anyway. So it's going to be Elliott wave structure at lower time frames, which is going to tell the difference between this alternate and the main wave count, or a new all-time high. At the weekly chart level, if we move the degree of labelling of the entire bull market beginning in March 2009 all down 1 degree, then instead of a grand supercycle degree trend change coming up when this structure is complete, we could just be looking at a cycle degree trend change. Following cycle 1, when it could be complete, we could then see a brief, relatively shallow little bear market, possibly to correct to not much more than 20% of market value, and possibly to be over within a year or so, and then the resumption of a multi-decade bull market. This is a very bullish wave count for the longer term. The short-term structure and validation points and labelling is all exactly the same. The difference between this weekly chart and the first is probably best viewed on monthly charts, and again I link back to those every day and every week for Lara's Weekly. Classic technical analysis now. This week completes an upward week with a higher high and a higher low, but the candlestick is red. There was downward movement within the week. The volume profile for this week, because this is contradictory, is best viewed at the daily chart level. A higher high this week does not come with a new all-time high from on-balance volume, and on-balance volume has failed to confirm this high from price. That's slightly bearish. At the weekly chart level, ADX indicates an upward trend still in an early stage. This is the strongest signal ADX can give. When it rises up from below both directional lines from low values and starts to rise up and reaches 15 or above, it's indicating a trend in an early stage. This one's an upward trend because the positive DX line is above the negative DX line. MACD is full bore bullish. But at the daily chart level, because things are quite extreme, there is a greater risk of pullbacks and consolidations to relieve extreme conditions. ADX for the upward trend reached very extreme back here, and RSI reached overbought. There's triple bearish divergence between price and RSI, and ADX at the daily chart level is declining, telling us there's no clear trend. It's not being able to catch up with these pullbacks and consolidations. With RSI having reached overbought and then exhibiting triple bearish divergence, the risk of a more time-consuming consolidation or a deeper pullback is heightened, and now we've got 3 candlestick reversal patterns, a small cluster. We've got a dragonfly doji here, and now we've got a hanging man candlestick. Altogether, these may be taken as reasonable warning that the market is more vulnerable to consolidation or pullback here. Resistance at 3350 was broken on Friday. Look out for next support. That was support broken. It's now resistance. Look out for next support about 3214. I've drawn that across these lows back down here. So there should be reasonable support there. Thursday and Friday, price moving lower, volume pushing price lower. And so we'll expect some more downward movement next week. It seems reasonable and would support the Elliott Wave count. We've been over ADX. ATR is behaving normally. It tends to rise as price falls and fall as price rises for this particular market. On balance volume failed by a really small margin to confirm the last all-time high on Wednesday. And so that's slightly bearish. If there is a consolidation or pullback, there's not enough bearishness here to expect it's going to be particularly severe. It may be just a sideways churn that could be quite shallow to relieve extreme conditions. We've been over RSI. This is bearish. MACD gives a bearish crossover on Friday to support the Elliott Wave count, and stochastics remains overbought. At the weekly chart level this week, price has moved higher, but the AD line as a measure of market breadth has declined. Upward movement this week in price does not have support from rising market breadth. This is an instance of a single week of bearish divergence and offers a little support to the Elliott Wave count. At the daily chart level, Thursday gave us an instance of bullish divergence between price and the AD line that's not been followed by any upward movement. It was followed by downward movement. It's considered to have failed, but it could be a slight warning that pullbacks or consolidations here could be more short-term and relatively shallow in nature. At the weekly chart level this week, both price has moved higher, but inverted VIX has moved lower. This is actually an instance of single week bearish divergence and again may support the Elliott Wave count. And at the daily chart level on Friday, prices moved lower, but it didn't make a new swing low below this prior point, whereas inverted VIX has made quite a strong new swing low below that point. This is a strong instance of bearish divergence and also supports the Elliott Wave count. That's all from me this week with your S&P analysis. I hope that all our members are having an awesome weekend.